Welcome to Mauuak Saving Tips. Today I dive into the challenge of navigating a volatile market and uncovering the smartest investment strategies to protect my portfolio. In today's unpredictable financial landscape, smart investment strategies are more crucial than ever. With market fluctuations happening rapidly, it's easy to get caught off guard and make impulsive decisions that can hurt your portfolio. But what if you could stay ahead of the game and make informed choices that help you thrive, even in turbulent times? The truth is, investing in a volatile market requires a clear head and a solid plan. It's not about trying to time the market or making wild guesses. It's about being prepared and having a strategy that works for you. By understanding the right investment strategies, you can minimize risks and maximize returns, even when the market is unpredictable. So, let's start with the basics. A smart investment strategy is all about being proactive, not reactive. It's about anticipating market changes and adjusting your portfolio accordingly. This might mean diversifying your investments, hedging against potential losses, or taking advantage of opportunities as they arise. Investing in a volatile market can be intimidating, to say the least. Fear and uncertainty can creep in, making it tempting to pull out of the market altogether. But history has shown that markets tend to bounce back, and those who stay the course often come out on top. The challenge is, it's hard to predict when market volatility will strike. One day, everything seems fine, and the next, the market is plummeting. This unpredictability can lead to sleepless nights and impulsive decisions that ultimately hurt your financial goals. Many investors struggle with the emotional roller coaster that comes with market volatility. It's easy to get caught up in the fear and anxiety that spreads quickly through financial news and social media. But successful investors know how to separate emotions from their investment decisions. One of the biggest risks during market volatility is making knee-jerk reactions. Selling low and buying high is a recipe for disaster. Yet it's a common mistake many investors make. By having a solid strategy in place, you can avoid this trap and stay focused on your long-term goals. Another challenge is the potential for losses. In a volatile market, even the best investments can take a hit. But with the right strategy, you can mitigate these losses and stay on track. It's all about being prepared and having a plan. Market volatility can also lead to missed opportunities. When the market dips, many investors view it as a time to be cautious, but savvy investors see it as a chance to pick up quality investments at a discount. By being prepared and having a clear strategy, you can capitalize on these opportunities. The key is to stay informed, but not obsessed. Keep an eye on market trends, but don't let fear or anxiety drive your decisions. With a solid strategy and a clear understanding of your goals, you can navigate even the choppy waters of a volatile market. So, what are some smart investment strategies that can help you thrive in a volatile market? Let's start with diversification. By spreading your investments across different asset classes, sectors, and geographies, you can reduce your exposure to any one particular market. Another strategy is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's performance. By doing so, you'll be buying more shares when prices are low and fewer when they're high, which can help reduce the impact of volatility. Defensive investing is another approach. This involves focusing on investments that tend to perform well during market downturns, such as bonds, gold, or defensive stocks. By adding these to your portfolio, you can create a buffer against potential losses. You can also consider hedging strategies such as options or futures contracts. These can help protect your portfolio against potential losses. But they can be complex and require a good understanding of the underlying investments. Active management is another strategy that's gaining popularity. This involves regularly reviewing and adjusting your portfolio to respond to market changes. By being proactive, you can stay ahead of the game and make informed decisions that help you thrive. Some investors also swear by the power of cash. Having a cash reserve can provide a safety net during market downturns, allowing you to take advantage of opportunities as they arise. It's worth noting that no single strategy is right for everyone. The key is to find what works for you and your financial goals. By understanding your risk tolerance, investment horizon, and goals, you can create a personalized strategy that helps you navigate market volatility. Here is a surprising strategy that can empower you to thrive even in turbulent times. Focus on the things you can control. Instead of worrying about market fluctuations, focus on what you can influence, such as your expenses, savings rate, and investment strategy. Many investors get caught up in trying to predict market movements, but the truth is, it's impossible to predict with certainty. By focusing on what you can control, you can reduce stress and anxiety and make more informed decisions. Another key insight is the power of patience. Investing is a long-term game, and those who can stay the course often come out on top. By avoiding impulsive decisions and staying focused on your goals, you can ride out market fluctuations and achieve your financial objectives. It's also essential to have a growth mindset. You market volatility as an opportunity to learn and improve rather than a threat to your financial stability. By being adaptable and open to new ideas, you can stay ahead of the game and make the most of market fluctuations. Some investors find it helpful to have a what-if plan. Think about how you'll respond to different market scenarios and have a plan in place for each. This can help you stay calm and focused even when the market is turbulent. Remember, investing in a volatile market requires a clear head and a solid plan. By understanding smart investment strategies and focusing on what you can control, you can thrive even in turbulent times. In conclusion, having a solid investment strategy is crucial for maintaining financial stability during market fluctuations. By understanding smart investment strategies and being proactive, you can minimize risks and maximize returns even in a volatile market. A well-thought-out strategy can help you stay focused on your long-term goals, rather than getting caught up in short-term market movements. By being prepared and having a plan, you can navigate even the choppy waters of a volatile market. The key takeaway is that investing in a volatile market requires patience, discipline, and a clear understanding of your goals. By following these principles and staying informed, you can create a portfolio that works for you, not against you.